Welcome everyone to today's webinar. This is session 6, Mitigating Cryptocurrency Investment Risks. We are very excited about this groundbreaking complimentary 8-part webinar course that is designed to support financial advisors as they navigate this new world of blockchain, cryptocurrencies, and digital asset investment opportunities. I'm your moderator, Dara Albright, co-founder of D-Wealth Education, a new edtech platform that's dedicated to providing incentivized learning to financial professionals, business executives, and investors, modern day investors, that is. Today, our distinguished presenters are Jahan Jamali. As you may all know from our previous session, Jahan is a former intelligence officer and leading expert on emerging technologies, global risk management, and international relations, as well as a renowned cryptocurrency educator. Also joining us today is John Sarson, Jahan's colleague and also co-founder and CEO of Sarson Funds. And John is also a leading cryptocurrency and digital asset investment management expert with a distinguished career in financial services. Both are routinely sought by the media to talk about how blockchain is shaping finance. So we've got a lot to talk about today. This is going to be a really interesting one. Before I hand over the mic, just a couple of housekeeping items, make sure you're all aware of. Number one, the webinar will last an hour. There'll be 50 minutes, 50 presentation time. At the end, we'll save the 10 minutes for Q&A. But if you have questions as they come to you, feel free. Type them into the public chat. Just make sure to put a question mark on that so we know that that's a question that you do want answered. And feel free to chime in, use the public chat. But only make sure that if you're using the public chat, it's because you're talking about something related to the conversation. It's not a space for any kind of advertisements or anything like that. Also, as a reminder to everyone, Investments and Wealth Institute has accepted this webinar for 1 hour of CE credit towards the CIMA, CPWA, CIMC, and RMA certifications. But regardless of whether you have one of those certifications or not, everyone who completes the entire 8-part program will earn a level 1 crypto advisor certification from Sarson Funds. And that will demonstrate not only your cryptocurrency and digital asset expertise, but what's really groundbreaking about this is that the completion certificate will be issued in the form of a non-fungible token, an NFT. And it really is truly groundbreaking, very excited. And Jahan may talk a little bit more about that, but you'll learn more about that as well. Also, there's some information in the resources section where Jahan actually is on a podcast talking about that, so you can listen in on that as well. And with that, I say, Jahan, let's just jump in.
Absolutely, Dara. Thank you very much, and welcome everyone to session 6. For those of you whose this might be your first adventure with us, I am Jahan Jamali. I'm the Chief Marketing Officer and co-founder of Sarson Funds. And while normally I'm dialing in from my Massachusetts-based office, decided to go somewhere a bit warmer. I'm dialing in today from Miami. And as Dara mentioned, we will be delivering your certification completion in the form of a non-fungible token, an NFT. And that's actually why we're down here. My team's here at NFT Basel at the FTX Arena, which is a gathering of some of the biggest non-fungible token projects in the crypto space. So well, while I'm here joining you today, the rest of my team is down there at the show. But just to give you a little bit of context of why we got a change in backdrop today. In the middle of my program, I'm going to be joined by John Sarson. He's our CEO and CIO at Sarson Funds, my co-founder, longtime friend, and he's going to really help shed some light and additional context on some of the risk elements, counterparty risk, that we're going to talk about today. So I'm really excited for today's session, and I hope you guys are too. Just as a reminder, if you guys have questions, we do have some Q&A that's afforded to us at the end of the program today. Just put those in the chat, question mark next to them, just so we know that it's a question. And we'll get to those as soon as we can, and if there's ones we don't get to during our time, we'll be sure to answer them after the fact. You'll get our emails after the session is ended today. Without further ado, let me roll forward. And we're gonna have some polling questions too, so feel free to participate on that. That's always a good gauge for us. Dara's gonna be putting in some questions throughout the presentation today. So if you guys see those, just pop in your answer, and that helps us sort of guide the session so it's most helpful to everybody. As I've said before, the way we designed this educational program is really from the top down. We want folks to really get a good grasp conceptually of digital assets and cryptocurrencies without getting too much into the details right at first, but we start to go in a little bit further in depth with every session that we've had today. So we hope you find that format helpful, and as we continue the program after this initial 8-part series, we're going to get into a lot more finer detail that I think you guys will really find exciting. But let's talk about what we're going to go over today. We're going to talk about mitigating risk. And we're going to talk about that in a little bit more in depth and a little bit more of a higher level as well than we did in the original, one of our previous sessions, which was Secure Cryptocurrency Investing. So we're going to talk about cryptocurrency investment risk in general and some of the risks that are associated with digital asset ownership, of course. But we're also going to talk about smart contract risk and understanding the risks associated with smart contracts. And if you guys remember, smart contracts, pioneered by the Ethereum blockchain, is a way in which you can put rules and conditions onto digital asset transactions and how this might apply to a client's risk profile. We're also going to talk about a lot of issues around pump and dump schemes. And I know that oftentimes the media likes to key in whenever there's a fraud or some type of scheme happening in cryptocurrency. And that causes a lot of fear, uncertainty, and doubt, where otherwise it might not be needed. But we want to help explain some of that and what that means so that you guys can understand where to look and how to look in order to mitigate that for yourselves. We're going to talk about custody. What does that mean, right? This is this is digital assets. There's no stock certificate. There's no hard currency. So what does custody mean in counterparty risk as it pertains to digital assets? And of course, one thing that's always on a lot of folks' minds is regulatory risk, right? I'm a former government official. I have a little bit of insight into how the government works, but I want to help you guys explain or understand how the cryptocurrency community is really asking for regulation and provide a little bit of definition on what the regulatory risk is and how regulators are working to understand digital assets in the same way that you're working to understand digital assets, and that we're all in this together. So we're going to talk about the regulatory landscape as well. Then we're going to talk about spotting scams, right? Scams are abundant, and they are not unique or germane to digital assets. Scams have existed since the dawn of time, especially when it comes to issues of finance. So we're going to talk about how to spot some of the scams that are happening in cryptocurrency and how you can be aware and best protect yourself, and how you can translate those protective policies into protecting your clients' assets as well. All right. Risk is there. Risk is inherent, and risk is most pronounced when you don't know what you're doing. All right, as the great Warren Buffett has said, as well as Adam Smith, this is just part of understanding how to play the game. So we like to put that quote up there as a good segue into the meat of our presentation. All right, so let me just lay this out there. Risk is not unique to digital assets. You guys know this, all right? But sometimes we get caught up in either media stories that we see, or really just sort of caught up in our lack of understanding of what cryptocurrencies are, where if we don't know, we immediately think there's risk inherent in there. But all investments carry some degree of risk, whether it's stocks, bonds, mutual funds, ETFs. They can all lose value, even all of their value, depending on market conditions, depending on news, depending on, if it's a company, there's, some type of issue that's happening within the company's leadership. Those all can add to the risk factors inherent in any type of investment. And I always like to point out, I do think it's hilarious that before we ever even had a Bitcoin futures ETF, the SEC and other regulatory bodies thought it was perfectly fine to have, marijuana ETFs way in advance, and other types of alternative and emerging, investable vehicles. So that always kind of baffled my mind. But anyway, I don't want to get too much off topic on that. FINRA's working on this, and not only regulatory bodies, but there are also SROs, self-regulatory organizations, that are working on this as well. One that we're a member of at Sarson Funds and that we're a big fan of, we think they're doing some fantastic work, is called the Atom, and you guys can check them out at atom.io. It's run by Michelle Bond. It's the Association for Digital Asset Markets. And we feel that regulatory policies are best set by the participants in the market themselves. And they are doing a fantastic job of educating regulators and educating lawmakers. So there's a lot of activity happening behind the scenes that a lot of financial professionals might not otherwise be aware of, and helping FINRA and helping the SEC and the CFTC understand how to best navigate this space and try to use and apply existing rules that are already there for other types of investment options, and see how they can best apply those to digital assets.
So interesting. I just want to jump in for a second, Jahan. We launched the first poll, and it looks like the majority of the audience, when asked what they consider to be the greatest risk when investing in cryptocurrencies, is hacking. So maybe, I know that you're going to address that, and it might be a good time to now actually launch the second poll, which would be, what would they consider to be, what would they consider to be the greatest risk of investing in general? And that goes to what you were just speaking about. And then maybe that could be for, talking about that for the rest of the.
Absolutely, absolutely. And we're going to talk about hacking here in a minute. We've talked before in our earlier sessions how the blockchain itself is not really hackable. However, that does not preclude it from being taken advantage of by human errors. And we're going to give some examples, especially what happened with Mt. Gox. So we'll talk about that in a few slides, of how bad security practices internally and human error and human greed led to a very large Bitcoin hack, which had some lasting ramifications on the Bitcoin market. So I'm definitely going to address that, and I'm glad to see those poll answers coming in. But of course, why do we care, right? Why do we care about digital asset adoption? The digital asset market is growing exponentially. It's actually, I think, now over $3 trillion measured by total market cap. And as I've said before in one of my earlier sessions, there is a running theory on the growth of digital assets, and why it's a little bit different than stocks due to a concept called Metcalfe's law. And Metcalfe's law lays down the mathematical foundation for the growth of networks. And these aren't stocks. These are not necessarily companies. These are payment networks. These are networks for exchange of value. And just like the fax machine, just like the telephone, just like the internet itself, network connections really add to the value growth curve of a digital asset, where you can, independent of the price action itself, the value of a network grows exponentially with every new connection that's made. So one of the things you do want to look at, one of the things that we look at here as a firm in evaluating a digital asset, is how many new wallets are being opened, right? We'll look at price, of course, but how many new entrants, how many new participants in that network are coming on each time, because that has a significant impact on what the growth curve of that digital asset's going to look like. So, we've seen brands, we've seen major companies, we've seen publicly traded firms now sticking Bitcoin and other digital assets on the balance sheet. So it's becoming more commonplace. And, Bitcoin, Ethereum, even stable coins like Tether, they've all become acceptable payment methods, even Dogecoin, right? Dogecoin is a personal favorite of mine. I think I've said this before. Dogecoin is the ultimate community coin. And it started off as a joke, but now it's being accepted by AMC. It's being accepted by other brands as a form of payment. And like I've also explained before, these aren't all necessarily currency tokens. I know we call it cryptocurrency. Some are a store of value. Some serve other functions. Bitcoin is your digital gold, but you're not going to go buy a pack of gum with it. You want to make a small purchase, you might consider using Dogecoin. And now we have publicly traded companies that have now adopted to it. So it's something that we legitimately have to start caring about. All right, so let's talk about custody and counterparty. All right. So custody itself involves the storage or safekeeping of the cryptographic keys. And just as a reminder, everybody else, for those that were on the earlier sessions, we have really two main methods of how you custody crypto. It's either on a hot wallet or a cold wallet. And just as a quick reminder to folks, that hot wallet is cryptocurrencies that you hold on an exchange. And the exchange is holding your private key, right? There's that public key, that's your public address, that's how you receive cryptocurrency. But there's your private key, that's like the key to your safe deposit box. And in a hot wallet or hot storage solution, like most exchanges are, the exchanges themselves are custodying that private key. So that's usually the easiest on-ramp for folks, either Coinbase or Kraken or Gemini. But for folks that want to self-custody, there's cold storage. And that's removing the private key off of the exchange onto a cold storage wallet device, like a Nano Ledger X or the Arculus wallet. There's a handful of external. That means they're not connected to the internet somehow, that you're actually custodying the wallets. So, the custody risk involves the safekeeping of those keys. So that's one of the considerations that you're going to have to make when evaluating, all right, how do I want to hold my cryptocurrency? Do I want to go with an established exchange? I know that our firm, we balance counterparty risk. We spread them across major exchanges, major U.S. exchanges for the most part, that have longevity, that have reputation, that they themselves have protection. We don't self-custody or have cold storage wallets, just in the same way that if you're trading stocks for your clients, you're not actually holding the stock certificate. They're held by the bank, and you're not going to actually want the physical stock certificates. So for us, by spreading out across several different major verified, vetted exchanges, that's how we balance our counterparty risk. And that's something that's a practice that, if you really want to get in depth into cryptocurrency, that you might want to start to consider, and not having all of your cryptocurrency holdings all in one place, right? Why would you do that with your money? Most people don't just have one bank account. You might have a couple. So you want to take those same considerations that you make for your normal, or I call it normal currency, for your fiat currency and your traditional investments. You take those same principles and you just apply them to cryptocurrency. It's really not all that different from a logic standpoint. Now let's talk about custody risk for a minute. John, do you want to help me out? And I'm going to invite John Sarson on, our CEO and CIO, and we want to talk about private keys and how they allow users to access their digital currencies and how to protect from unauthorized uses. And then we're going to roll into talking a little bit about the Mt. Gox debacle and what happened with all that. We'll give you guys some context on that as well. But John, thanks for joining us today.
My pleasure. Yeah, good to be here.
All right, so John, what happens when somebody gets a private key compromised? What does that ultimately mean?
So you can think of your private key might as well be your Bitcoin itself. That is access to your cryptocurrencies, and with your private key, someone can take your money and move it into their own wallet to forever be out of your reach. You can try to take that person to court if you can find that person, and the court can demand that they send it back. There's not a lot of good examples to point to of funds being successfully recovered once they've been stolen in the cryptocurrency world. There are some, but we want to avoid the possibility of compromising our private keys at all costs. You can think of it like your stock certificate or a bearer bond. Remember a bearer bond for the financial professionals in the world? Like if you had the bond and then you sent in the coupon, like you got the dividend. It didn't matter who sent it in. Whoever had the coupon got the dividend. And this is kind of the same thing with private keys. If you have the private key, that's your crypto. So we want to make sure to defend and protect our private keys like the way we would defend a stock certificate or a bearer bond. And with Sarson funds, we think that we kind of take the other side of the argument where many in the crypto world say, like, not your keys, not your crypto. And you could say the same thing about the stocks you own. Oh, if you don't have the stock certificates, then you don't own those stocks. And I think everyone on this call would agree that that's not a congruous statement, right? So clearly you can own stocks and have them held by a custodian, and they keep those stock certificates safe on your behalf. And the same bears true for having your cryptocurrency on an exchange. But we want to understand that unlike Merrill Lynch, that has like a SIPC insurance that protects you in case of an insolvency at Merrill Lynch, there is no such similar thing for cryptocurrency. So the issue of counterparty risk becomes very real. And at Sarson Funds, we take it exceptionally seriously. On our flagship product, Blockchain Momentum, a large coin strategy fund, we insist on having a minimum of 5 counterparties, all in the United States, at all times, to make sure that never is there any more than 20% of our assets exposed to a single counterparty. Now, the exchanges that we have in the United States, as we've mentioned on an earlier program, we recommend majoring in the majors, right? So the Coinbases and the Bitrexes and the Krakens and the Geminis, we think that they're an exceptionally safe place to keep your cryptocurrency. You know, many of these firms are supported by the largest financial institutions in this country, the BlackRocks and the Fidelities and the Goldman Sachses. You know, they're in business to offer financial services, not to steal your cryptocurrencies. And I believe that. I'm not a conspiracy theorist. I think that the exchange is a very good and appropriate place for cryptocurrency for most people, for most endeavors. The idea of counterparty risk became very apparent with the most famous hack in all of cryptocurrency's history, which happened in 2013 to a firm called Mt. Gox. Mt. Gox was founded in 2010 as a playing card trading platform, which quickly became a Bitcoin trading platform. And by 2013, they were handling about 75% of all Bitcoin transactions. In 2013, they had a hacking event where 850,000 Bitcoin were stolen. They were a Tokyo, Japan-based company. And as a result of that hack, which at the time was worth $450 million in the current value, they declared bankruptcy. So this was in 2014, they declared bankruptcy. There's a couple of really key takeaways from the Mt. Gox bankruptcy. One is that you can expect an amazing amount of illiquidity to stem from one of your counterparties declaring bankruptcy. The regulators and the legal officials were able to recover 200,000 of the 850,000 Bitcoin that were stolen. And those 200,000 Bitcoin that were recovered are still sitting in the trustee's wallet as they're continuing to go through bankruptcy liquidation processes in Japan. And it has been 8 years almost, or 7 years, almost 8 years since they've declared bankruptcy. So the creditors that are owed these 200,000 Bitcoins collectively have had to sit with an illiquid position for the last 8 years. Now, it's worked out okay for them. The current value of those 200,000 Bitcoin is $11.8 billion. So many of these creditors are looking at a windfall when they finally do get paid, and they're expected to be getting paid this year. In the coming months, it's been the final distribution of these Bitcoin has been delayed several times for COVID and for other reasons. But that's been in a liquid position for 7 years. And it's caused a lot of US-based cryptocurrency investors to have to become experts on Japanese bankruptcy laws, which is something probably none of them ever had a desire to become an expert on in the first place. It's one of the reasons why at Sarson Funds, we like to have our counterparties in the United States, because we understand how bankruptcy works in the United States. And we also, it's why we diversify across 5 counterparties in our flagship fund, Blockchain Momentum.
And just to give you guys a little bit of context too. So when this happened, right, what was the price of Bitcoin? $530.
Yeah. And more context, it caused the price of Bitcoin after the news came out to fall to $100. So Bitcoin on the news of this fell from $536 to $100 in seconds as Mt. Gox declared bankruptcy and closed. So that kind of volatility was almost a death knell to Bitcoin in 2014. It was only a 4-year-old network at that point. But the anti-fragile nature of Bitcoin ultimately ruled the day, and Bitcoin came back to life and is currently sitting at $58,000 per Bitcoin now.
Which is actually brings up another kind of point, John. We've talked about this before. How many 80% dips has Bitcoin had in its life?
Yes, Bitcoin has corrected by 85% or more 5 times. So like 5 times in 11 years, Bitcoin has fallen by 85% or more, which is quite a lot of volatility. And after it happens for 5 times, you can start to say maybe this is a feature of this asset class. And so we think about that a lot at Sarson funds. What happens is we tend to have one of these 85% corrections, and then the growth of the asset price will move exponentially, and it'll do on average about 20 times higher than its previous all-time high, and then it will fall again by 85%, as kind of like the bubble, the boom bust cycle repeats itself. If you think of Bitcoin's last all-time high of being 20,000 that we saw in December of 2017, 20 times higher than that's around 400,000. And so Bitcoin hits 400,000, I would say it'd be ripe for another 85% correction.
Yeah. And this, if you really want to get heavy into the mathematics of it, I do encourage you all read about Metcalfe's law, understand the types of volatility that occurs in a large-scale logarithmic network growth, and hopefully that might mitigate a little bit of fears. But John's absolutely right on that.
Yeah, we believe that the safest place for your crypto is on an exchange. The exchanges have learned lessons over the past 11 years, and they've really become more professionally managed when it comes to risk management, hacking risk, and you look at a company like Coinbase. Coinbase has an enterprise value of $100 billion. So if there was a $1 billion hack at Coinbase, or a $2 billion hack at Coinbase, or a $10 billion hack at Coinbase, it doesn't seem likely to me that they would go out of business and declare bankruptcy.
Yeah, and in the early days too, especially with the Mt. Gox example again, right? The Bitcoin was stolen over a period of time. It wasn't taken all at once. And from all, a lot of the major news on the investigation seems to kind of point that was an inside job. They didn't, back again to that basic logic and of security. Most of the Bitcoin was sitting on one wallet in Mt. Gox, and that only a few employees had access to, and that's obviously that's immature and dangerous in and of itself. And we've come a long way, especially now that regulators have started to get involved, and now that we have companies and exchanges like Coinbase that are publicly traded. That we've come a long way since those days. But at the end of the day, it wasn't necessarily it's not a hack of the blockchain. That's just bad security practices in general. That's like having a bank with 3 people that have the keys to the vault, and then just sort of turning around and not watching.
Yeah, and ultimately the CEO of Mt. Gox at the time was found guilty of financial fraud, because he despite being acquitted of gross negligence charges, he was found guilty of financial fraud for trying to cover up some of the early indications that there was an issue. The assets in the accounts have been purchased by Kraken, a US-based exchange. So Mt. Gox's current iteration is the firm Kraken, which we think is one of the premier exchanges in the United States, and we do use its Sarson funds. They bought the assets from the bankruptcy. So it's a cautionary tale. There's been other hackings that have caused other exchanges to go bankrupt. There was an exchange called Cryptopia that went bankrupt in 2018 from New Zealand. And I had a personal account with Cryptopia, and it's still going through bankruptcy liquidation proceedings. So I have no idea what my outcome is going to be there. But the idea is that you want to diversify your assets across several counterparties. Ideally, keep those counterparties in the United States, where we understand bankruptcy laws the best, and major in the majors would be my advice to you.
Yeah, we got them right there on the screen, and I can't emphasize that enough, right? Major in the majors, as John is saying. Go with established names. Everybody wants to chase the alpha, but I can assure you there's plenty of alpha in the major exchanges that have already been established. I think it's kind of dangerous security practice to start chasing new exchanges because you want some random new meme coin that's coming out. That's kind of ridiculous. We've got plenty of more upside in the overall adoption of digital assets. So look to the major exchanges, and we've got the top 5. That were top 5 as of this month, according to Forbes. So that would be our recommendation in terms of how you want to mitigate and spread out that counterparty risk. So let's talk about smart contracts for a minute. Take a little bit of a pivot. We talked about how we believe that these digital assets are going to be stratified over a variety of different use cases. So let me just remind everyone what a smart contract is again. Smart contracts are programmable and self-executing agreements. They can have rules and conditions applied to them. And this is all, of course, done on the blockchain. And Ethereum was really the pioneer. Ethereum, the largest, second largest cryptocurrency by market cap size, in the smart contract aspects of digital assets. So some examples of that are digital art, and that's obviously been big news as of late in the NFT space, where terms and conditions that govern the interaction are determine the validity of the purchase on the blockchain. And we've also seen this quite a bit in the financial sector too, right, John, with loans, investments,
Yes.
and DeFi specifically. What are the risks, pros and cons with counterparty risk when it comes to like DeFi and like yield farming and liquidity pools, right? Where do you see like the benefits and some of the areas of risk?
Yeah, it's a really important topic and something we spend quite a bit of time creating best practices for. So when you're dealing with investing in cryptocurrencies as a long-only passive investor, exchanges are a great place to do that. When you start to want to utilize some of the more exotic features associated with cryptocurrencies, specifically smart contracts, you're going to be doing that off exchange. You're going to be doing that on your browser from your own wallet, from your MetaMask wallet. You're going to be going to different websites, connecting your MetaMask wallet, and entering into a contract on that website, typically on an Ethereum contract, typically, but not always. Sometimes there'll be Solana or Harmony or Alchemix or Polkadot. These are different blockchains. So what that contract says is basically, these are these if-then statements that we covered in an earlier program. Bitcoin itself, not capable of a smart contract. Bitcoin is a binary, I have money, Jahan has money. Now he sends it back to me, but very binary. But a smart contract is available on a cryptocurrency that is capable of a Turing complete programming language, meaning that it's capable of if-then statements. So if I lend you $100,000, then you pay me 5% annually, paid monthly, or else I get the collateral back, right? And these types of contracts are exceedingly useful. I mean, people are just storming into DeFi because they allow us to do all modern banking functions without the structure of a bank. We love smart contracts at Sarson Funds because unlike a bank loan, for example, which I'm sure many of you have invested in, my background was at Guggenheim. We really specialized in credit products and bank loans. You have covenants, and you have to watch the covenants. And then, like, if the covenants are violated, you have to say, okay, well, you violated the covenant. Either you have to pay back the bank loan immediately, or we want to like impose new penalty rates on the loan. And like Guggenheim has built themselves an amazing, $100 billion financial complex, like being experts at babysitting these covenants and making sure that there's a covenant violation, then like they like can go on the offensive or they can go on the defensive, depending on how they feel the credit position is of that company at that point in time. With a smart contract is much better, because when the event is triggered, we as the lender are still attached to the asset. We just pull it back. It just comes back, and it's all on chain. So we never have to like hope the company or the person is going to send back the collateral. It's all on chain. We're attached to that asset through the smart contract. And the only problem is if there's a flaw in that smart contract where maybe the programmer itself has either intentionally or unintentionally left some type of a back door where it says like, something deep in the code where like, unless you put the letter P here, then you put the letter P here, then all of a sudden like, then skip step 3 through 8, and then like all of a sudden you've got a smart contract with a vulnerability. And so these smart contracts are audited. There's a couple of different firms that are auditing smart contracts. CertiK is one that we look at. And there's other firms that are insuring against smart contract flaws. One of the safest ways to avoid problematic smart contracts is don't be the first person in a new smart contract. We have a rule at Sarson Funds where we won't touch a smart contract pool until it has at least $30 million locked. And the reason we chose that number is because there's been a number of times where there's been vulnerabilities in smart contracts, and as assets start getting locked into them, the development team exploits the smart contract through their intentional vulnerability, and they steal the money. It's called an exit scam. They basically like take the money and abandon their project. And typically they do this at locked values of less than 30 million. I guess people around the world have decided that a $25 million theft is enough to keep them going for a while. So a smart contract with less than $25 million of total value locked in it, we have no interest in being in that smart contract. When something gets above the $30 million threshold, now we start to feel like, okay, probably these founders are not scam artists. And so now let's evaluate this. And there's many other thresholds that we use. For some of our public products, we don't invest in a smart contract until it has $1 billion of collateral locked. But like looking at the size of the smart contract is a great way to determine how long the contract's been around for and like reduce your chance of an exit scam is what it's called.
Yeah, let's talk about schemes for a minute since we're on that topic. All right, pump and dump schemes. And that is exactly what it is and what it sounds like when scam artists take advantage of people while making money and sort of like pull the rug out from underneath them. And there's a variety of ways in which this can happen. I'm going to talk actually about sort of a non-traditional way, just because we were on the NFT topic for a minute. So if you're going to mint an NFT, if you're going to get in on a new NFT sale, as John was saying earlier, typically you would go to that website and connect your wallet to it. Now, as the NFT space has been blowing up over the last few months, what has been happening is that scam artists have been quickly making copycat versions of the original site and having an ability to connect your MetaMask wallet to it. And you would, think you're, buying an NFT right from the site, and really they're just taking your money, and they've mimicked and mirrored the whole site. So obvious, ways to mitigate against that. Don't invest in projects where you can't verify who's running it, right? There's lots of stuff that sounds cool, it has a great marketing spin, but if you can't verify that these are legitimate project runners, that they don't have an established history, if there's no team mentioned anywhere, avoid, absolutely avoid. Or if the team is only a Twitter handle or some other type of avatar, avoid. Why would you put your money into a cartoon? You want to be able to verify the team. You want to be able to verify the project. You want to be able to verify the partners. And this goes for traditional non-NFT digital assets as well. Now, there's a lot of new exciting things happening in the digital asset world. You want to be able to verify that it's an established team, that look to see if they've received funding from an established venture capital firm or other types of outside investors. Look to see who their partners are. Verify those partners as well. Here's another thing. We live in an era of disinformation. This is not just unique to crypto and digital assets as well. For those of you that don't, I'm a marketing guy at heart. If you don't know how a press release is done, it's actually really easy. There was a press release that was done a few months back where Walmart announced that Walmart was now accepting Litecoin. Now, the press release syndication protocol doesn't necessarily have an area where you validate you're from Walmart to send that message out. And of course, this was not true, and Walmart had to quickly retract. So even when you see press releases come out on the wire from PR Wire or from Access Wire or any of these types of wirehouse syndicates, you want to go back to the original project or company that's referenced and see what's on their press page to make sure that that's real and legitimate. Because so once that thing gets syndicated out through one of these wirehouses, it gets picked up automatically by a lot of these syndication services before the actual firm has time to make a public statement that redacts it. So you want to be able to verify, and not just a quick Google search. Go to the actual program's page. Go to the actual firm's page.
Let me share some best practice with the group here on that exact point, Jahan. If you have learned about a project through an email that came to you, it may be an official email, it may not. A great way to make sure you're on the correct landing page is go to that project's Twitter and look, like if there's a couple of similar names on Twitter, and one has 30,000 followers and one has 330 followers, like you want to go to the 30,000 follower. That's their official Twitter. And then you're going to go from their official Twitter or Discord. Discord is even better, really. You're going to go from that page to their landing page. You're not going to navigate to their landing page from the email that was sent to you, because it's going to look identical, but you may not be in the right place if you didn't go there from their official channel. If you're not on Discord and you don't feel comfortable going on to that platform, you shouldn't be doing independent, exotic maneuvers in cryptocurrency. It's a prerequisite for safe operating in cryptocurrency is going to the Discord. You can straight ask in the Discord, is this the correct landing page? And like the moderator of that Discord will tell you, yes, this is the correct landing page if you can't figure out where to find it. And like take this extra step along the way to make sure you don't get scammed. It can be very, very tricky to understand if you're on their official page or a slightly spelled different version of their official page that's been pasted to, it is their official page, pasted onto a fake landing page. And the only difference is going to be where you send the money is going to be to the scammer.
Exactly. I mean, here's the thing: don't fall for clickbait, right? Whether it's clickbaiting your email or whether your text. And again, these things are not, these tactics and techniques by scammers are not unique to crypto. I got a text message even myself like 2 weeks ago telling me that my Wells Fargo account has been closed and I need to click this link in order to access my Wells Fargo. I apologize that we got a lawnmower outside, and hopefully that dies down here in a second. But here's the thing: I don't have a Wells Fargo account. Somehow my number was on a list, and these scam artists just blast out the contacts that they have. So use common sense. Use the same security protocols and practices that you would otherwise use in your bank, that you would otherwise use in your email. But don't fall for clickbait. All right, let's talk about the regulatory landscape for a little bit. All right. It's early in crypto, and like any early stage in any type of new emergent market, there's a higher degree for the risk of market abuse or manipulation. And like I said before, in a few other areas, it's not unique to crypto, but crypto is in an early stage. So regulators are still struggling with this. And for those of you that might not have had any government experience, but I mean government experience, I mean if you've actually ever worked for the federal government, you know it moves at the speed of an iceberg, right? Cryptocurrency moves at warp speed. So regulators are having a hard time processing this. And it's compounded by a lot of stakeholders in the traditional financial system that have a lot of say on Capitol Hill, that have a lot of say on K Street, right? And K Street's a euphemism for the lobbyist groups that are in Washington, D.C. And it stems really from a lack of education and understanding. However, we're making big inroads into this. We're making big strides. As I said before, there's organizations like the Atom, the Blockchain Association, that have really stepped up in helping to educate lawmakers and policymakers start to understand this. And where before it was dismissed, then it moved on to fear. Now it's moved on to a slight embrace. We have, we had this infrastructure bill that went through, and there was a lot of conversations happening about the crypto provision in there. And it really, a lot of that conversation and debate happened due to a lack of understanding. But we have some members of Congress and members of the Senate that have really stepped up. Congressman Tom Emmer is one of them. Also the senators from Wyoming that have really started to understand that the United States needs to grab this and grab it fully.
Paul Gosar from Arizona sponsored the Cryptocurrency Act of 2020, which died in committee, sadly. But the idea is that cryptocurrencies need to be covered by existing regulatory agencies, the SEC, the CFTC, FinCEN, and it seems like the SEC and FinCEN are bear with us a moment, please.
Yeah, bear with us just one moment. We get
hey, sorry, someone's washing our window. The dog is quite angry about that. So it seems that like these existing regulatory agencies are starting to understand that certain cryptocurrencies are going to be classified as commodities and managed by the CFTC. Others are going to be deemed securities and managed by the SEC. And others are going to be deemed cash instruments and managed by FinCEN. And until these regulatory agencies get their arms around these specific cryptocurrencies, there's been a real reluctance to create regulations for how they should be traded or how certain trading should be disallowed. We need to see anti-price manipulation legislation passed. It's currently not illegal to manipulate the price of a cryptocurrency. It's one of the consistent reasons that the SEC cites why they don't approve a Bitcoin ETF. How can you approve a Bitcoin ETF on something where it's not against the law to manipulate the price of it? So this is why the futures ETF has been a better fit for them. So now we've got a futures-based Bitcoin ETF product because it is illegal to manipulate the price of a future for the purposes of making a profit or avoiding a loss. So we're getting there a little at a time. And to Jahan's earlier point, crypto zooms ahead. Raoul Paul shared a really remarkable statistic on one of his recent podcasts. If you haven't seen Raoul Paul, he's a fabulous macroeconomic orator. He used to work for Goldman Sachs. And he pointed out that cryptocurrency is being assimilated the fastest any new technology has ever been assimilated. When the internet had 100 million users, where crypto is about right now, it was growing at 68% year over year. And that was at the time the fastest adoption of a new technology in history. Right now, at 100 million users, cryptocurrency is growing at 113% year over year. So it's growing almost twice as fast as the internet grew, adoption grew. And that was previously the record holder for the fastest a new technology has ever been adopted. So it feels like things are moving fast. It's because they are moving fast. The fastest a new technology has ever been adopted around the world.
And, we have up on the screen here, like I said, crypto is moving fast and regulators are trying to keep up. But this is a kind of a general timeline of, how far we've actually come in the last 8 years. We've gone from being dismissed and being seen as a fraud to regulators really taking it seriously. And even now there was a presidential task force on examining, the feasibility of a Federal Reserve central bank digital currency. That conversation at the White House level was unheard of 5 or 6 years ago, just to really kind of put it into some context.
Yeah, want to hear any neat concept around digital central bank backed US currencies? There was a stimulus program around COVID where everyone got $1,200. You may have seen some of the reports, like how do you put this into Bitcoin, like how much money it will be worth now, quite a bit. But imagine now, instead of citizens were issued digital programmable money, and that programmable money wasn't allowed to be invested in the stock market. It wouldn't work there. It would only work in certain types of institutions. Maybe it works at a supermarket or a consumer goods store, but it can't be transferred to your brokerage account, and it expires. It expires at the end of the year. So programmable money is one of the reasons why crypto is not all downside for the Fed. Programmable money is a really exceptionally useful tool for the Fed, and I think they're excited about the fact that they can now say, like, here's your stimulus money. It has to be spent on, in this category. It has to be spent by this day. All of a sudden now stimulus can be very targeted thanks to programmable money, and that's a smart contract on top of the central bank-backed digital currency.
Yeah, I think that's a fantastic point as well. There's a lot of layers deep to this once you start to peel it back, and I think the federal regulators and lawmakers are slowly but surely starting to figure it out. All right, so let's start to wrap up a little bit so we can save some time for some Q&A. All right, I just want to remind everybody how to spot the scams. All right, don't fall for clickbait. Anything asking you for a cryptocurrency payment. Right, just replace, on all of these examples, just replace cryptocurrency with dollar and ask yourself these same questions, right? Make sure it's coming from a legitimate source, like John says. Double check, triple check, and verify. All right, unsolicited emails, unsolicited messages, right? Investment opportunities that you didn't ask for or didn't inquire about. Things that say urgent, right? Or look like they're too good to be true. They probably are true.
A deal that no one knows about yet, but like somehow has come into your inbox. This is one of the reasons why we like large US exchanges. By the time a coin or a project makes it onto Coinbase, it's not a scam. It may be a bad investment, but it's not a scam at this point because the vetting process is significant and that protects you. That offers a lot of protection. If there's a project that's planning to list on Coinbase, and by buying it before it lists on Coinbase, you are going to achieve outsized investment returns. You're also taking on outsized risk, and just be fully aware of that.
Absolutely. And so just to wrap up with some key takeaways, all right? Despite the immutable nature of blockchain, scams happen in the crypto world, right? It's ultimately blockchains and crypto projects are created by people, and people are inherently imperfect, all right? Avoiding crypto scams from the start is your best defense, all right? Don't FOMO into projects you haven't verified.
Have we covered the definition of FOMO?
Oh, FOMO, fear of missing out.
Yeah.
All right.
It's a hot term in cryptocurrency. People FOMO into a project, meaning that they're afraid of missing out, and they just buy it before they do their research. And that is one hallmark that all scams have in common.
Absolutely. And when in doubt, zoom out. Right? Take a step back. Do a little extra research. Do a little extra verification. All right. Remind yourself of what those red flags were, and trust an expert. And by the time you get done this 8-session program, that expert for your clients is going to be you. Right? So it's important to have these practices for yourself as well. All right, you're going to carry the certification with you, and it's going to say, hey, look, I understand the components here of how to manage risk and watch out for scams in digital asset investing. And just like folks might look to you as a fiduciary with their traditional investments, are going to be doing the same with their digital asset investments too. So really take that to heart and make sure you employ some of these best practices into your personal investments with the cryptocurrencies, so that you can translate those best practices over to your clients. And Dara, I think that brings us right up to the 50-minute mark, and I'm really excited to take some questions from folks.
So we have a question here that is asking, isn't it better to think of all but stable coins as crypto assets? That's how they behave. What are your thoughts there?
Well, stable coins, just because they're stable to the U.S. dollar or stable to another currency. Well, I mean, I would say, like, you got to zoom out on that. Like, how stable is the U.S. dollar, relative to things like inflation and other types of monetary policy?
Yeah, I'll take a stab at this. So clearly, stable coins are going to be regulated by FinCEN because they are just another digital representation of currency. All other crypto assets are not all securities, and the reason why is because some are utility tokens. Like, imagine a crypto asset that powers an encryption. We work with a project called Crown Sterling. They have a crypto token called Crown Sovereign, and the token offers 1,000 encryptions using their highly sophisticated quantum-proof encryption technology. We love the project, but it's not a security; it's a utility. So that's clearly should be not managed by or not overseen by the SEC. Maybe instead it should be overseen by the CFTC because it's like a commodity. So there are differentiations that occur when looking at individual crypto assets. I don't think it's fair to lump them all into one bucket.
And you guys talked a little bit before. I thought it was interesting when you talked about you won't go into a project that has less than 30 million into a pool, and you talked about TVL. Could you talk about some of the sites you guys go to monitor the total value locked when you're looking into some of these DeFi projects? Yes,
we use DeFi Pulse. DeFi Pulse, you can push that into Google and you'll see like overview of the DeFi world. CoinMarketCap, which we've mentioned earlier, it's like the Bloomberg for crypto. They have a whole section on DeFi. Thank you, Dara, for putting that in the chat. There's also DeFi Llama, which is very kind of like granular and really in the weeds of crypto. It's a great resource. So we would definitely recommend looking at some of these data aggregators to kind of do your own research on these different DeFi platforms and see how much value is locked. Although usually they'll indicate on their landing page, on the DeFi platform page, how much value is locked in that smart contract, and then just put on your clipboard and then drop it into your browser. It'll pull it up on Etherscan. You can see for yourself. Don't just trust what it says on the web page, because web pages can be falsified. But Etherscan's not falsified. I saw also a note appear from a question from Damien about buying an asset before it got on Coinbase that he found on a launchpad. Launchpads are a really great way to help reduce your likelihood of falling for a scam. So Damien, that's a really great point. But not every project that's on a launchpad is going to be 100% scam free, because the launchpads themselves can be tricked. But it's another layer of protection. So it's a good idea to stick to the launchpads. So we're talking about like Bolt to starter, anything that's like says starter in its name is typically like a launchpad. Coinbase has a launchpad. So yeah, launchpads are a really good idea and a great place to look for speculative ideas. As financial advisors, and I know many people want to call our financial advisor, investing in small cap cryptocurrencies is not too dissimilar to investing in speculative biotech or technology equities. And you should think of your clients' allocations as being like their investment grade assets that are going to be in large caps, or medium caps, and they're going to be professionally managed away from their browser. And then maybe they have a pool of speculative money that's a smaller amount of money that they want to try to buy the equivalent of like moonshots, right? They want to buy some tech companies that their friends are talking about, or biotech companies, only these are going to be cryptocurrencies. And I would suggest that some of them are going to work out wonderfully, and that you'll be probably, clients will appreciate that you encourage them to do that speculation, but this should be separate from their like long-term strategic investments in crypto, because it is speculating more than it is investing when it comes to these startups that are trading at 1/100 of a penny, the Shiba Inus, that are basically just hoping on the meme token phenomena to rocket their price up 1,000x. And some of them will work wonderfully, but many will not. And it shouldn't be the majority of a client's investable crypto assets, in my opinion. I'm a financial advisor, so I'm allowed to offer a financial opinion.
So Eric is asking, are there Sarson funds offerings where you have done the research for customers, or would they still need to do their own due diligence themselves? And if these offerings exist, could you give an example in relation to cryptocurrencies?
Yeah, so we have the most flexibility to flex our research muscles in our small cap product. You can see on our webpage, we update our factoid on the webpage every quarter with the 40 small cap projects that we're investing in. We really pride ourselves on our transparency. That's not to say that all of these projects are going to end up being problem-free, but these are projects that have passed our due diligence, are part of our portfolio. But as I mentioned on a previous podcast here, we believe in the power of diversification. So if one of our 40 projects were to have like a problematic outcome, it's only going to represent a small fraction of the portfolio, and there really is safety diversification. So I caution anyone against just going through our 40 names and picking one or two that they like. I think that you lose all of the benefits of diversification by doing that. Our small cap product is open to accredited investors. There's a $50,000 minimum, and there's a 90-day hold period required. And we're delighted to take new clients that are looking for that type of exposure. Frequently, we find clients that have a lot of crypto expertise. They enjoy buying Bitcoin and Ethereum themselves, but they want to use our research team and our process to do their small coin allocation, and we are delighted to help them with that.
That's great. And could you address any potential regulatory changes, including in anything from the Build Back Better legislation?
Yeah, and that's still ongoing too, in terms of how that legislation is going to be interpreted by the regulatory bodies. I mean, in the main discussion and the main item of concern for the crypto community was what the definition of a broker was, and how, and that really got to the crypto community in quite a poignant way. So I think that with there's a handful of amendments, and there's a handful of policy discussions happening right now with regard to how that's going to be implemented in practice, because the law still is the way it was still quite a bit vague. So we're going to see how that plays out. So I will be more than happy to follow up with that in the next week or two once we have some more insight from our people in Washington.
Yeah, and I believe, I'll just add to that, I think Congressman Emmer actually introduced, co-sponsored a bill recently addressing that very issue.
That's right.
So there is legislation that will give more clarity to the definition of what a broker is. Yeah,
that's for anyone that didn't see that legislation come out. What happened was that anyone that was mining a cryptocurrency and then selling it, all of a sudden the legislation suggested they should be classified as a broker or dealer, essentially, and subjected to that type of scrutiny. Clearly, there's a difference in character between someone that's mining in their garage and selling $500 worth of tokens to the market as they're being mined versus what a broker-dealer's role and responsibilities encompass. But we believe at Sarson Funds that legislation will be patched long before it goes into effect. And the Emmer proposal is exactly the type of a patch we expect will pass Congress. Cryptocurrency firms are well represented in Congress, and cryptocurrency advocates are members of Congress. So there's a lot of reasons to be optimistic that this type of draconian, like possible to enforce and like non-thoughtful legislation will be fixed before it becomes an issue.
Great point. Great point. Well, gentlemen, we're running up on that 1 hour mark, but thank you so much. This was really educational, really phenomenal, actually. And like I said, I look forward to watching it again because I watch these multiple times and I always get more out of it. But we look forward to seeing everybody again. We're going to do the next one in 2 weeks, December 14th. I know it says December 7th here, but it's December 14th. And we will follow up, as always, after here with just more details, as well as links if you want to watch this again. And then links to register.
Yeah, we're getting up on that time too, Dara, for the NFT certification. So if you missed some previous sessions, go back on the D Wealth Education site and get caught up so we have you registered. You'll also get a copy of Deep Crypto, the book that John and I had authored. It's available at Target and Barnes & Noble, but you'll get a complimentary copy for completing the 8 sessions with us. So if there's 1 or 2 that you might have missed, you get an extra week to catch up. And we're thrilled to have you guys join us each and every time. We really do enjoy doing this for everyone.
I think Jahan mentioned we're in Miami for NFT Basel, which is at the FTX arena. FTX, of course, being a cryptocurrency exchange. And the mayor of Miami spoke, and Miami Coin, which was launched just 3 months ago, has already netted $15 million of profit for the city of Miami. And so we expect to see a lot more city coins in the near future. It's really a golden moment in cryptocurrency and bringing revenue to communities where revenue is badly needed. A lot of positive things coming on the back of cryptocurrency adoption for the country.
I love it. We'll leave off on that great optimistic note. Well, thank you so much, guys. This was fantastic.
Thank you, guys.
Thanks, Dara.
Thanks. Bye.